Good evening. Today was the RBI policy, and I thought I would do a brief analysis of the policy and what it means for the markets. So, before I step into the analysis of the policy itself, let's take a minute to understand what is RBI's role and how does it differ from, let's say, the Federal Reserve in America, right? Now, the Federal Reserve is also a central bank, just like RBI. But if you look at the role of RBI, right, so it's slightly different from that of the Fed. So what is the RBI's role? I would say RBI's role is to actually to ride a cycle well. Now, what is the allegory with the cycle? Because the key element in riding a cycle, as all of us know, is balance. So RBI's job is to maintain a balance, right? The Fed also is the same truth. So what is this balance? The balance is between growth and inflation, right? So each one of them sets a target for the inflation and they try to make sure that we achieve the inflation target but don't give up the growth. So the balance between the two is key. But there's one small difference here, even in this. If you see by the charter for the Fed, they have to maintain the balance between growth and inflation. But in RBI's charter, as the governor pointed out today in the post press conference, is that in RBI's charter, while growth and inflation, the trade-off has to be managed, the managing inflation is the key thing. It's more important than supporting growth. That's in the fundamental charter of RBI. So that's one subtle difference, that as RBI, they will always pay a little more attention to inflation than, let's say, a Fed. That's one. There's another big difference also in terms of RBI versus the Fed. What is that? That is the fact that RBI also has the job to maintain a balance in the currency. That is neither excessive depreciation nor excessive strengthening, because as you know, depreciation helps exports but hurts imports, and vice versa is appreciation. So RBI cannot be favoring either the import or the exports, but Fed doesn't have this role because US dollar currency is the reserve currency for the rest of the world and they have no control over how much dollars come in or go out. So it's a fully capital convertible currency, right? So to that extent, RBI's role is more important. Now there again, you will see the balance between depreciation and appreciation is tilted towards managing depreciation well. Why? Because we are a net trade deficit country and we are a current account deficit country, right? Trade deficit means we import more goods and services than we export. So naturally, if the currency weakens too much, then it is a bad for the imports from a perspective of that ultimately those costs are going to come down and affect inflation. This is called imported inflation, right? So in the case of RBI, then just to summarize a bit, right? While there's a growth inflation trade-off and a currency appreciation depreciation trade-off, the balance is always towards a little more importance to inflation and a little more importance to not allowing too much depreciation. One final point on the currency is that everybody tends to look at the dollar US INR versus dollar rate and say that rupee is weakening versus that. But RBI's job, because India, yes, a significant portion of our exports is to America, no doubt about it, but the fact is that we deal with a number of other G20 countries. So RBI's job is not just to manage the dollar rupee, but they manage the currency against a basket of currencies. And so when RBI looks at a rate to see whether they have themselves done a good job in balancing, it is to maintain what is called the REER, R-E-E-R. What is this? This is the real effective exchange rate, where they take a basket. Now there's a larger basket which on a longer term they measure, but on a weekly basis at least they manage a basket of 7 currencies. The typical suspects: the British pound, the euro, the German Deutschmark, the Japanese yen, and of course the dollar, right? So managing this basket is more important because we have imports and exports from all of these countries. So that's a subtle point of view difference. So this is from a base. And one more job for the RBI, which is not there for the Fed, which is called the Public Debt Office, which they manage the borrowings of the central government, the state government. But that is just what I call a broker related job, right? Just like a private corporate would give a dealing of their borrowing to a broker, in this case, you will RBI does it for them. They don't charge anything or whatever minimal, but that's an execution job. But that's also a critical job, because then RBI gets to know exactly how much the central government is borrowing and how much the state governments are borrowing. So they get the first-hand data about the borrowing. Not that they control it; it's the governments decide how much they want to borrow or not, but they get an eye into it, so they can manage the liquidity, right? So that's the base on the RBI. Now, how does RBI does this action, right? So there are basically RBI's job is to manage what is called as the monetary policy. Now, within the monetary policy, there are two arms to it. There's a liquidity management, which is demand and supply of money, and there's an interest rate management, which is managing the rate at which RBI lends or borrows from the banks, right? So these are the two tools they use, and currency is interlinked. And let me explain to you in a little bit why. Because when, let's say, the rupee is depreciating, that is, let's say, like FIs are pulling out money, somebody needs to go and supply the dollars to them. So when RBI does that, they suck out liquidity from the rupee, convert it to dollar and pay. So whenever RBI is fighting the rupee to prevent depreciation, they are sucking liquidity out of the market. Now, when you succeed in pulling out liquidity from the market, naturally demand and supply of money gets affected. That has a negative impact on interest rates, because shortage of money is a commodity like anything else. So it is the currency management part of RBI and the liquidity come interest rate management have a close linkage with each other. One affects the other, right? That's one thing which to know before we do that. So then we come now to the current RBI policy. Now, what's the difference between this RBI policy and the previous one? Yes, first is that we have a new RBI governor. How does it make a difference? Because the new RBI governor has come from the government, from the DFS, Department of Financial Services. In fact, till he was appointed here, he was probably working closely on the pre-budget documents, right? So the first thing is that he has a very recent, proximate look at the fiscal, what the government is planning and everything. So that knowledge is critical, because no monetary policy, which is RBI's fiefdom, can be done in isolation without the fiscal policy also being taken into account, right? For example, a fiscal deficit increasing will cause inflation to rise. So RBI has to counter that inflation if the fiscal deficit is increasing, right? Just for an example, right? And second is, in the case of inflation, remember one thing, inflation comes when there's a mismatch between demand and supply, right? So either demand is greater than supply, that's why there's inflation. Now, the rise in inflation could be because supply is coming down, or supply costs are going up, or it could be because demand is going up. Now, the key there is from India perspective. India is a developing country. America is a developed country. What's the big difference? In the developed countries, the demand is very high. So generally, they have a demand pull inflation, whereas in India, supply is high, right? Whereas demand is not that great. So we have a supply push inflation. For example, in our CPI basket, as much as 46% comes from agri and food and pulses and fertilizers and all of that, right? 46%. Whereas in the US, the same 40-45% comes from housing related demand. So in India, it's a cost push. Why I'm stressing this point is that the government can impact the supply. They can put import duties, they can put export duties, they can do a lot to manage the supply. So inflation has a fiscal management side to it in addition to a monetary. And because we are not a demand-driven inflation cycle, the limited impact of RBI's interest rate cut or hike on inflation, you got to understand, because on the supply side, these hikes don't make that much of a difference, right? So understand that RBI's very difficult job, because they are fiddling around with interest rates in a situation where the country is in a supply cost push inflation, as they call it. Remember this. So that's the first. That's it. We have a new RBI governor. We also have new members of the Monetary Policy Committee on board, because some of them retired. So that's also the second new. The third is that this policy is important, not only because it's the first one in this calendar year, but because it's coming close on a budget. Why I'm saying this, you have a fresh information on what the budgetary tendencies for inflation and growth are. And that has to be taken in by the RBI. So that's why this policy was very different and very important, right? So let me now come down to what the decisions by the RBI was. All of you might know the 25 basis rate cut was announced. Now, after a long time, a rate cut. We had a long rate hike cycle, then we had a long rate pause cycle, and now we have come to a rate cut cycle, right? Now, significantly, this is a big change in the trajectory, right? Why did this happen? Partly because we have had growth slowing down. We all know that Q2 GDP numbers were at 5.4 against estimates of 6.5, and the full year growth projections also from 7.2 have been brought down to 6.6 for the current year. So growth is slowing down. That's one factor in this. Second, on the inflation part. The inflation part, the previous quarter we had a high inflation because food prices was very high. And this is despite a good monsoon. Why? Because the monsoon was not even across. In fact, some places when it shouldn't have rained, it rained. So there was a supply shortage created. Second was the monsoon, which was good in places where it was not needed. And so in the place where there's a lot of demand, and essentially we are talking about is tomatoes and onions, and those key elements were the key that the monsoon came at the wrong time, and hence the supply. So in fact, if you see last year, the production of food and vegetables, right, vegetables and pulses was more than the demand. Despite that, inflation was high, right? So what has happened is that being set right now, and so in the month of January itself, you've seen food inflation come down. So that's given a comfort to the RBI that, oh, growth is slowing down, but inflation is also slowing down. So there is room, right? Now comes the fact that he did a 25 basis rate cut, and since the budget was also non-inflationary. Now, what are the important things to remember here? First is the fiscal deficit. Why did I call the budget non-inflationary? First is that the fiscal deficit was being pitched at a lower than the previous, right? We all know that for next year, 4.5 was the glide path. The finance minister has actually said we'll target 4.4. And they have maintained the government borrowings at the same level. They have, in fact, maintained the capex at the same budgeted level as last year's budget. A 10% increase over the actuals for this year is expected, right? So the government is not going to add to the inflationary pressures by its fiscal profligacy. That's one supportive factor which helps the RBI governor here. Second, I said that supply side was the main problem of the inflation, right? So in the supply side, the government has announced a lot of agri-related reforms to ease the supply burden so that we don't get a repeat. And most important was they're setting up a pulses board to make sure there is a proper supply, because pulses itself accounts for about 2.5% of the CPI basket. General other food, everything is about 8.9 plus another 2.4 comes from pulses. So the government is setting up an agency to manage the pulse shortage and requirement. So to that extent, fiscal measures are there to make sure that the supply of vegetables, pulses through agri reforms is getting taken care of. That is the second part. The third aspect here, and that's something where I want to dwell a little bit on, is this 100,000 crores giveaway. Right? Now, potentially on the surface of it, if this comes into consumption, there could be a theory that that much money coming into consumption will boost up prices and hence have a negative impact on inflation. But that's not really the case. Why? I think RBI governor also pointed out. So let me drill down a bit here. So first of all, this 100,000 crores money which the government is giving up in the hands of the people is not going to all go down to consumption. I was reading various reports and estimates, and I think by and large the consensus is out of 100,000 crores, 60,000 crores is what will go to consumption, and 40,000 crores may go into the savings basket, whether it's to bank deposits or to government savings schemes or to the mutual fund and the insurance companies, right? So it's a 60,000 crore impact, one. But second, even this 60,000 crore consumption boom, right? What it means is not going to be inflationary. Why? Because India's capacity utilization is only at 75%, which means another 33%, right? 25 divided by 75 is 33, remember. Another 33% products can be sold. There's the excess supply in the economy. So that demand comes, that excess supply will take care of it. So that's not going to create a shortage and hence force prices to go up. So even this, because of the low capacity utilization in the country, the consumption, whatever the going to result from this 100,000 crore giveaway, estimated at 60,000, is not going to be inflationary. So overall, you can summarize that the budget was non-inflationary, right? And from the government's RBI's perspective, right, they've seen a January food inflation come down, right? And hence they felt that given the fact that the growth was also slowing down, and given that with Mr. Trump coming, though Mr. RBI governor did not mention Trump specifically, he mentioned it as global uncertainties and global volatility. But we all know that it's been caused by Mr. Trump's statements and intended actions. It's created a huge amount of volatility in the international economy, right? So because of which, right, India's exports, for example, could be on a slight weak weekend, right? Import costs could go up. So because of this whole uncertainty around that, right, the RBI governor felt that there was comfort on the inflation because both the Rabi and the Kharif, both the crops have been good. So he expects that in the coming months, those Rabi crops coming into the market would continue to ease. So for this quarter, he was comfortable that inflation is on a declining trend for all the factors I mentioned, and growth was also slowing down a bit. And so a rate cut was announced at 25 basis points. Now all of this that I spoke about is the public domain interest. The markets were expecting that this would follow through because they also felt that the government and Mr. Mehrotra coming from the government would be very sensitive to the fact that growth needs to be given some kind of a push, and hence the market had discounted the rate cut, which actually came through, right? So that's on the interest rate policy. I'll come to the impact of the market a little bit later. But the next part is the currency part, right? Now on the currency part, 2-3 things. Yes, the rupee is been on a weakening trend. We know it's now at 87.42, right? Now, what has happened is that this rupee's depreciation, right? 2-3 aspects to remember here. RBI has done a very good job in managing it at 87.42. Why do I say this? Because actually speaking, compared to other emerging market currencies, rupee has actually strengthened. First, it's not weakened as much against the dollar as they have. But second, even the real effective exchange rate that I spoke about, right, the RER, we are at 106 plus, which means we are actually overvalued relative to the whole basket. Yes, against the dollar we are weakening. So RBI has done a good job, and in fact, they could have allowed the rupee to weaken a bit more than the RER would have come down. But they have been conscious of the fact that there's a public image to it and you have manage it. And their stated policy is always not to target a level for the rupee dollar, but to manage excessive volatility by intervening in the market and using their reserves. Now, what has the RBI done? They've used a huge amount of their reserves, but they still have $630 billion of reserves, which is equal to 10 months imports. So there's no cause for panic on the currency, but RBI has enough to manage even the future flows. But remember one thing, right? The Indian currency is going to be on a weakening trend vis-a-vis the dollar. What is the reason? The way the fundamental value of the currency is determined is something called as interest rate parity, which is a subset of something called purchasing power parity. Interest rate parity, in a way, is to look at the risk-free rate between America and India. And we all know that what is the rate now? America is at 4.51 for 10-year. India is at 6.73 today after the policy. So that's 2.22. So if you take a 2.22%, that difference, the rupee has to weaken. That's the fundamental law of currency that says, because otherwise there's an arbitrage. Somebody can bring money from there, earn this differential interest rate without taking a risk. So this zero arbitrage theory of currency says that if this holds good for the next 1 year, the rupee should further depreciate by 2.22%, which on 87.41 means that we'll be at 89.34. All other things being equal, RBI can allow the rupee to go to 89.34 without rupee actually weakening. It is only readjusting to the dollar. So that's where one of the things that's important here is the rate cut actually helps. Why? Because before this rate cut, to after the rate cut, I was telling the 10 year. The 10 years don't directly reflect this, but you take on a short-term basis, right? We have reduced interest rates by 25 basis points, US has not. So the interest rate differential is narrowed. So in fact, the interest rate cut was also an attempt by RBI to manage the rupee's depreciation by narrowing the differential down. So the reason for the rate cut has got another twist to it, which is currency management. But that being said, there is a liquidity issue with currency management, because when RBI buys dollars, right, or whatever supplies dollars, there is an impact on the rupee liquidity. So what happens is that every time RBI defends the currency, they suck out rupees to be able to buy the dollars. So there's a huge liquidity shortfall. The RBI governor said that in December, this was mainly the liquidity shortfall was due to advance tax outflows. True. But subsequently, the fight of the rupee is also, that's why RBI announced these liquidity measures, right, to compensate for their own actions in sucking out rupee liquidity to defend the currency. They had to supply liquidity through the repo rate auctions, VRR, and all of that, right? So that liquidity is also a key part of managing interest rates. And so the second aspect there is, I will come to the market's impact on this in just a bit, right? So now I have covered the interest rate. I want to now look at the growth aspect, because all of this translates. So what is the RBI's view on growth? RBI, as you know, the economic survey came and expected the growth in a wide band of 6.3 to 6.8. But RBI has been very, very concentrated, saying we should get 6.7, which is at the higher end of the band. Now, prima facie, a rate cut will increase a slowdown, but RBI is actually at the higher end of the band. So, which means what? The confidence of the RBI that growth will rebound. Now, where does this come from? Right? First, it comes from the consumption boost that the government has provided through the tax break, right, to the tax relief. So, that will give a growth boost to the consumption side of the economy. Second is they've launched a lot of agri-related reforms. So, agri plus the monsoons being good will lead agri output. So, agricultural GDP part of it should also hold up and be strong. The third aspect which the governor pointed out was the fact that the PMI, manufacturing PMI, is showing a very positive at a 57% level. At the same time, though the services PMI has dropped a bit, it's also healthy at 56. So which means that the business outlook both from manufacturing and services is augurs well. Means the people who are polled in the PMI, the purchasing managers themselves, are optimistic based on their order book. So he sees this as a positive for growth to come back. So the government's support plus the government is also going to spend about 11 lakh crore on capex. What they last year couldn't do, they reduced by 10. This year, if they do even the reduced amount, it's still a government expenditure which is going to come through. So the RBI remains reasonably bullish on the growth aspect, right? So that summarizes the situation. Now we'll just come to the markets. Now the markets haven't reacted very well. The market rose up before, came down sharply, then recovered a bit. But overall, markets have not responded in a very boom fashion to the budget, RBI policy. Why is that? So first of all, is that while doing the rate cut, RBI has not changed the stance from neutral, which was last time's stance. They have not moved into accommodative. The market was expecting that it will move to accommodative. What is accommodative versus neutral? What is the difference? Neutral means we are still waiting on the sidelines. Accommodative means we are there to strongly support growth. That's now I mentioned. RBI is very bullish on the future growth. So they are indicating that we don't want to be accommodative because we want to boost growth even more. We see it coming back. So that is read by the market saying no more rate cuts. Whereas originally, while market was not only discounting 25 basis points rate cut now, but 75 basis points over the year, that probably the market is a bit disappointed because RBI, and post in the Fed conference also he mentioned that this is a very specific rate cut for this period, right? So that is one. Second is the market is also expecting that because the rupee dollar continues to weaken, RBI continues to have to fight it. They are going to continue to suck out liquidity. So RBI will announce some more liquidity measures. Like last time there was a CRR cut, maybe one more CRR cut or some more liquidity measures. Market was disappointed that that did not come through. Again, why? Because governor said this is a very short outlook only for now. I am not saying anything about the future. So clearly we have not entered a downward rate cycle, which the market wants. So since the market already discounted a 25 basis rate cut, today they are not looking at any further rate cuts happening. In fact, because this rate cut has happened, now the chances of a future rate cut come down because RBI has front-loaded it in a way. So the market is saying, oh, that means we are not yet in a very supportive, accommodative environment on interest rates, and equity markets love that reducing interest rate scenario, which is not the outlook to be seen, right? So these are the aspects which has made the market not jump up with joy and boom today as a result. And also bear in mind that this is not the only factor driving the markets. The global uncertainty still weighs heavily. FII flows also are dependent on that. So there are a lot of other factors to the market. So it's not fair to say that the RBI policy disappointed hence the market. The fact is that the RBI policy did not give a overwhelming boost to the equities as an asset class today, right? So that's the thing now. What about the sectors in the market now? Because of this rate cut, first of all, EMIs coming through. Now that's challenging. Now I know SBI has announced today that they will reduce the EMIs, they will reduce the interest rates. But look at it this way, right? From a bank or an NBFC perspective, right? There is consumption demand, right? Coming through with the 60,000 crore. Now, all the companies are sitting on excess capacity. They all want to push their products, right? So there will be subvention given by the consumer companies to boost their sales. Now, the banks, if they are going to reduce interest rates, right, it means they may have to reduce deposit rates. Because if you see floating rate loans and fixed rate loans, there are very limited fixed rate loans, some personal loans maybe, some auto loans maybe. But the floating rate loans, right, they are linked to either an external benchmark, which is the repo, which has come down, or into a marginal MBLR. So now what happens is that if they have to reduce that, they have to reduce the deposit rate. Now, as it is, banks are struggling. The overall RBI governor mentioned today, 80% is the credit deposit ratio, which means out of 100 rupees, 80 rupees is already being lent. So if they want to lend more, they have to raise more deposits. And they are not going to be able to raise more deposits, which are going to cut interest rates, right? As it is, they are facing a challenge with the mutual fund industry. You've seen from COVID time, from 11-14% to mutual fund to bank deposit, we already now past 31%. So already they are facing a challenge from mutual fund savings coming in and taking away. If they say they can't reduce, now if they're going to reduce interest rates on the loans but not reduce on the deposits, then the net interest margins are going to shrink. So that's why from a banking sector perspective, right, this thing is not exactly a very positive boom at this point in time, because we have got to wait and watch. Now SBI has taken the lead and said we'll cut. Now can the others do it? Then it's all going to be at the cost of NIMs. Some banks may choose not to do it, saying I want to protect my NIMs, but if loan growth doesn't happen, it happens. So it's a wait and watch, and you have to see how it is. And NBFCs, because they in turn rely on the banks for their borrowings, are naturally going to get impacted at this level. So that's one of the reasons that the overall bank index and all that did not see. We'll have to wait and watch how individual players play it out and whether they are going to actually cut interest rates on deposits. That's the key part to watch out for, right? The other aspect of it is today is that yes, whichever banks do a cut, like SBI, for example, is going to be a boost for consumption. So that's why you saw today auto, realty, consumer durables, all of these were the positive sectors today. So naturally, the 100,000 crores, of which 60,000 is expected to be in consumption, plus any savings in EMI, will mean that there will be a boost to discretionary consumption, and hence there was a rally in that discretionary consumption space. So I think that gives you a look. So I think we got to watch and see how the interest rates play out. But the fact that RBI is very positive about future growth and reasonably confident on inflation means that we probably shouldn't be expecting a quick set of another interest rate hikes coming through at this point in time. I hope this detailed analysis of the RBI policy has been simple and has made sense to all of you. So look forward until my next video to you. All the best and happy investing.